Three traders are looking at the same market on the same day at the same price. One is buying the breakout. One is selling the reversal. One is doing nothing. None of them is wrong about the chart. They are simply asking different charts, different questions. In this video, we take one trade on ES1, the continuous E-mini S&P 500 futures contract, and build it across 3 timeframes, where each chart has exactly one job. The weekly chart answers the first question, where is the trap? The 4-hour chart answers the second, has that trap already been sprung? And the 15-minute chart answers the third, at what price am I actually allowed in? When all 3 answers point the same way, you have alignment. When you skip one, you end up with the right idea at the wrong price, which is the most expensive way to be right in this business. You will see a liquidity sweep above a major weekly high, a change of character on the 4-hour chart, and a retracement into the optimal trading zone, where 3 execution models are waiting. So, if this kind of content helps you, take a second to like the video, subscribe, and turn on notifications so the next lessons reach you the moment they go live. And feel free to share in the comments which topics you would like us to explore in future videos. And if you want to support the channel on a deeper level, consider becoming a member to unlock exclusive content and help keep these lessons coming. You'll also find links to our trusted partners in the description below. Using them costs you nothing, and it directly helps the channel keep producing free educational content like this. Now, let us begin. This framework is built on top-down analysis and multi-timeframe alignment. We use the weekly chart for bias, the 4-hour chart for structure, and the 15-minute chart for execution. A single chart tells you what price is doing. It cannot tell you whether it matters. Importance comes from context, and context always lives above you. Question 1. On the weekly chart, where is the trap? Here, we are not looking for entries, but for the level the whole market can see, a major swing high sitting there like bait. Instead of expecting continuation through it, we anticipate a liquidity sweep above that high, followed by price returning back inside the trading range. If that rejection forms a bearish reaction on the weekly chart, we establish a bearish higher timeframe bias. Question 2. On the 4-hour chart, has the trap been sprung? A sweep on its own proves nothing. We wait for a change of character, also called a market structure shift, to align the 4-hour structure with the bearish weekly narrative. After that shift forms, we define the trading range and identify the optimal trading zone, or OTZ, between the 0.618 and 0.786 Fibonacci retracement levels. Question 3. On the 15-minute chart, at what price am I allowed in? Inside the OTZ, we will work through 3 execution models, a fair value gap and order block reaction inside the premium zone, a CISD confirmation entry, and an entry taken directly from 4-hour structure. So the weekly chart provides the bias, the 4-hour chart provides the structure, and the 15-minute chart provides the precision entry that aligns the entire setup in one direction. Although this example uses ES1 futures, the same framework can be adapted to different markets and multiple timeframe combinations, as long as the alignment between bias, structure, and entry remains consistent. Now, let us move into the real chart execution of the strategy, step by step. The first stage begins on the weekly chart, where we identify the last major swing high as our primary point of interest. At this point, we are not looking for immediate entries. Instead, we are waiting for price to reach that liquidity level and potentially trade above it. And it is worth knowing why we want price above the level. That is where the orders are. Stop losses from everyone who is short and buy orders from everyone waiting for a breakout. That pool is the trap. Once the weekly swing high is taken, we anticipate that the market may begin a bearish reversal. In other words, we are looking for a liquidity sweep above the previous high, followed by signs of bearish price delivery, returning back inside the trading range. This is the first split. To the breakout trader, that candle is confirmation, and recency bias tells him the latest move is the truest one, so he buys at the moment the trap closes. We read it as proof the level was used, not broken. Now, after the weekly liquidity sweep has formed, the next step is dropping down into the 4-hour chart, looking for structural confirmation aligned with the weekly bearish bias. Now, here on the 4-hour chart, we have the weekly higher high marked as our primary point of interest. This level represents the major high from the weekly time frame and the liquidity we expect price to attack before a potential reversal develops. At this stage, we are monitoring the 4-hour structure closely and watching for a possible change of character to begin forming. However, before that shift can happen, we first want to see price continue higher and trade above the weekly major high. The trap has to be baited before it can spring. As the next candles develop, price eventually breaks above the weekly higher high, which satisfies one of the main conditions of the framework. Now that the weekly liquidity level has been taken, we begin updating the structure markings on the chart. Since price continued moving higher, the possible change of character level shifts to the next 4-hour swing low. At the same time, a new weekly higher high is formed, because the previous weekly high has now been exceeded. Notice what just happened. We were right about the sweep, and the market immediately made us move our own line. This is where most traders abandon the plan. Structure updated faster than their opinion did, so they either force the short early or decide the idea was wrong. The framework asks you to keep the idea and move the line. At this point, we are no longer looking for continuation higher. We are waiting for a change of character on the 4-hour chart that may confirm the liquidity sweep on the weekly time frame. If the 4-hour structure begins shifting from bullish to bearish after the weekly high is taken, that becomes the first structural confirmation that the higher time frame liquidity sweep may already be in place. As the chart continues developing, price suddenly delivers a strong bearish move on the 4-hour chart and breaks below the protected swing low. With this movement, the market forms a change of character, signaling that the bullish 4-hour structure may now be shifting bearish. This becomes an important moment because the 4-hour change of character now aligns with the weekly liquidity sweep above the major weekly high. We no longer view that move as simple continuation. The combination of the sweep and the bearish structural shift is the narrative we were waiting for, and it is the answer to question 2. The trap has been sprung. Now, after the change of character is confirmed, the next step is defining the trading range. This becomes extremely important because the trading range allows us to identify the premium and discount zones of the move, as well as the optimal trading zone that we will use later for execution. Using the Fibonacci retracement tool, we can now project the OTZ between the 0.618 and 0.786 retracement levels of the bearish leg. This area becomes our potential premium retracement zone for short positions, aligned with the bearish higher time frame narrative. And because that band is doing all the work from here on, it is worth stopping for a moment to be precise about it. 2 ideas sit underneath everything we just drew, where price is expensive or cheap inside a range, and which part of that range is actually worth an entry. Let us take them in that order. So, traders, what is premium and discount in the ICT methodology? And why does it matter when analyzing price inside a range? Within the ICT framework, price is not equally attractive at every level of the market. The location of price inside the range matters, especially when looking for higher probability entries and better risk to reward opportunities. That is where the concepts of premium and discount become important. But before we understand these zones correctly, we first need to understand what a trading range actually is. A trading range is simply the space between a swing low and a swing high in a bullish scenario, or between a swing high and a swing low in a bearish scenario. These swing points define the boundaries within which price is currently moving. Now, let us begin with a bullish example and understand how the trading range is drawn on the chart. In a bullish scenario, the trading range should be drawn using the Fibonacci retracement tool, with the 0 level placed at the swing high and the 1 level placed at the swing low. This means the upper boundary of the range is defined by the swing high, while the lower boundary is defined by the swing low. Once the range is established, the area above the 50% level becomes the premium zone, while the area below the 50% level becomes the discount zone. These zones help traders evaluate where price is positioned within the current market structure. Once the trading range is established, if price moves higher and breaks above the previous swing high, this creates a break of structure, confirming bullish continuation. On the other hand, if price continues moving lower instead of breaking higher, the market may begin forming a change of character. So, the key idea is understanding the sequence inside the trading range. First, the range is established. Then, a retracement forms. From there, the market reaches a decision point. Once price breaks above the trading range, we begin identifying a higher low and a potential higher high as the bullish structure continues developing. This is why it is so important to learn how to mark the trading range in real time, instead of only studying static examples after the move is complete. As price evolves, the trading range must also be adjusted according to the developing market structure. However, within the ComLucro framework, the range only becomes fully fixed once price delivers a valid retracement, specifically reaching at least the 0.382 level, which is one of the criteria we use to define a valid pullback. At that point, the structure becomes more clearly established, allowing us to properly define the higher low and higher high on the chart. Until then, while price continues expanding upward, the trading range remains dynamic and adapts to the developing price action. Now, the same logic can also be applied in bearish market conditions. In a bearish scenario, the trading range is drawn from the swing high to the swing low using the Fibonacci retracement tool, with the 0 level placed at the swing low and the 1 level placed at the swing high. The area above the 50% level becomes the premium zone, while the area below becomes the discount zone. When looking for long trade opportunities, we generally want price to trade within the discount zone, assuming other factors support the setup. The deeper price moves into the discount area, the greater the potential risk to reward ratio becomes, especially when a stop loss is placed below the swing low and the target is positioned near the swing high. In bearish market conditions, traders typically look for short opportunities within the premium zone. The higher price trades into the premium area, the better the potential risk to reward ratio, especially when the stop loss is placed above the swing high and the target is positioned near the swing low. And that is exactly the case we are in. Our 4-hour range runs from a swing high down to a swing low, so the mirror applies. The upper half of that bearish range is premium, the lower half is discount, and a short belongs in the upper half, which leaves one question open. Premium is half of the entire range, and half a range is a very wide place to put in order. So the next step is narrowing that half down to the part of it that is actually worth an entry. So traders, what is OTE in the ICT methodology, and how can it help identify higher probability trade entries? OTE stands for Optimal Trade Entry. It refers to a specific Fibonacci retracement zone that aligns with discount for long trade entries and with premium for short trade entries. The idea behind OTE is to refine entry timing by focusing on areas where price is considered optimally priced within a range. It is important to note that ICT's original teachings define the OTE using the 0.62, 0.705, and 0.79 retracement levels. However, at ComLucro, we prefer to use the traditional Fibonacci retracement levels of 0.618 and 0.786, while still recognizing the importance of the 0.702 midpoint. We believe that using the classical Fibonacci levels increases confluence, since these levels are widely followed by traders across different methodologies and markets. So when this video says OTE, it means exactly that, the optimal trade entry, sitting inside the premium half of our bearish range, with the 0.702 midpoint between the two edges. Premium tells us which half of the range to work in. The OTE tells us where inside that half to place the order. And the reason we care about the deeper part of it is simple. The higher into premium we are filled, the closer the stop sits to the weekly swing high, and the more room the trade has to run toward the external liquidity below. And this is where the zone quietly asks you a question. The 0.618 fills far more often because price only has to come part of the way back. The 0.786 pays considerably more when it fills, and sometimes it never fills at all. Most traders take the first touch not because they chose it, but because waiting for the deeper level means sitting with an idea that has not paid them yet. However, we are still not looking for the final execution yet. Once the trading range and the OTZ are properly marked on the 4-hour chart, we then move down into the 15-minute chart to search for the execution models that will align with the higher time frame structure. Now, as we move down into the 15-minute chart, the bearish move from the 4-hour time frame becomes much more visible through the strong downside expansion. At this stage, we once again mark the trading range and identify the premium and discount zones, together with the optimal trading zone on the lower time frame. One important detail here is maintaining patience and discipline. Even though price has already delivered a strong bearish move, the objective is not to chase the market, but to continue following the framework and wait for price to retrace back into the premium area of the range before looking for execution. That wait is the hardest part of the model. Watching a move leave without you feels like losing money you never had, so the mind reframes a bad entry as action and patience as hesitation. You are not allowed in until price is back in premium. In addition to marking the OTZ, we also identify the fair value gaps and order blocks positioned inside the premium zone of the bearish structure. The first possible execution model on the 15-minute chart is using the fair value gap together with the order block as the entry zone. In this scenario, the entry is positioned at the opening of the fair value gap, while the stop loss is placed above the order block. The target is set at the external liquidity level, creating a 1-to-3 risk-to-reward setup. The expectation is that price may retrace back into the fair value gap, react from the premium zone, respect the order block without invalidating the structure, and then continue lower toward the external liquidity target. As we can observe, price retraces higher and eventually taps into the fair value gap, activating the entry. After the entry is triggered, price continues developing upward and comes very close to the stop loss area, creating temporary pressure inside the trade. However, if we zoom in and continue following the development of price action, we can see that the market spends a significant amount of time consolidating inside the order block and fair value gap region before finally continuing lower and reaching the 1-to-3 target objective. That consolidation is where this model is paid for. Loss aversion makes a position near its stop feel far worse than it feels good near its target, so the trader who entered correctly closes for a small loss out of relief, and then watches the trade work without him. The second execution model is a more conservative and confirmation-based approach. Instead of entering immediately at the fair value gap, we wait for price to retrace back into the fair value gap, or the order block positioned inside the premium zone, and then look for a CISD, or change in the state of delivery, to form on the 15-minute chart. Once the CISD confirmation takes place, the entry is executed on the candle confirming the bearish shift in delivery. The stop loss is then positioned above the high of the CISD movement, while the target remains the external liquidity level on the 15-minute chart. This creates a higher precision execution with an approximate risk-to-reward ratio of 1 to 3.5. As we continue following price action and zoom further into the chart, we can observe that price respects the bearish confirmation, continues delivering lower, and eventually reaches the full target near the 1 to 3.6 objective. Confirmation always costs something. You enter later, and sometimes not at all. What it buys is a tighter, better justified stop, which is why the risk to reward came out ahead of the first model. Now, let us go back to the 4-hour chart and explore the higher time frame structural entry. Compared to the 15-minute executions, this approach is slightly more aggressive because the entry is taken directly from the 4-hour structure without waiting for lower time frame confirmation. Once the change of character forms on the 4-hour chart, we define the trading range and identify the premium and discount zones together with the optimal trading zone. Using the bearish leg as our reference, the entry is positioned directly at the 0.618 Fibonacci retracement level inside the OTZ. The stop loss is then placed above the weekly high that created the liquidity sweep, while the target is projected toward the external liquidity resting on the 4-hour chart. This creates an approximate risk-to-reward ratio of 1 to 3.2. As we can observe, price retraces back into the optimal trading zone, respects the premium retracement area, activates the 4-hour entry, and eventually continues lower toward the external liquidity target, reaching the full 1 to 3.2 objective. The trade-off here is not precision. It is how many decisions you are willing to make. This entry asks for one decision and then days of doing nothing while the position breathes. Easy to describe, hard to hold. So which model should you use? 1 to 3 for the fair value gap entry, 1 to 3.5 for the CISD entry, 1 to 3.2 for the 4-hour entry. The choice is not about reward. It is about what you can execute. The fair value gap gives the best price and the most heat. The CISD gives the calmest entry and the risk of being left behind. The 4-hour entry gives the fewest decisions and the widest stop. And know what kills the setup. If price returns above the weekly high that produced the sweep, it was not a sweep. If the change of character never forms, there is no structure, only a bias. And if price never retraces into premium, there is no trade. So, weekly. Where is the trap? A swing high, swept, with price rejecting back inside the range. 4-hour. Has it sprung? A change of character below the protected swing low, and the OTZ between 0.618 and 0.786. 15-minute. At what price am I allowed in? Inside premium, at a fair value gap and order block, or on a CISD confirmation? 3 charts, 3 questions, 1 direction. If any of those answers is missing, the setup does not exist yet. So, trader, if this video brought you more clarity, like it, subscribe, and turn on notifications so the next lessons reach you. And tell me in the comments what you want me to cover next. And if you want to go deeper, you can become a member of the ComLucro Trader community right here on YouTube. It unlocks exclusive content, early access, and extra tools for your development, while directly supporting the channel. You'll also find our trusted partners linked in the description. Using those links costs you nothing and helps us keep producing this kind of educational content. And remember, the mission of the ComLucro channel is simple. We help traders build clarity, confidence, and structure, so every decision is made with discipline and intention. Here you'll find complete courses built as a true trading masterclass. Liquidity, market structure, higher time frame analysis, and supply and demand. Always focused on reading price and executing with a professional mindset. We also cover trading psychology, risk management, and long-term consistency. Because trading isn't just about charts. It's about mindset, discipline, and execution over time. Our main courses include smart money concepts, ICT, technical analysis, trading psychology, and Wyckoff. Alongside that, we share insights from respected traders whose work helps you understand how markets really behave. Thanks for watching, and I'll see you in the next video.